Alright, so continuing on the downtrend, at this juncture we should be alert for shorting more stocks as shown by the individual charts and group charts to be in a weak position. Alright, so the guy looks at group charts and individual charts while taking a look at the trend of the market. Okay, we know that he wants to sell the pullbacks. They should be sold on bulges, only on bulges. And the fact that the averages have declined from the top about 10 points is an indication of a partway rally, which normally is likely to fall slightly short of the recovery, about half of the decline. What's he saying? It's going to go about halfway back. That's all he's saying. So what's he saying? There's going to be a bullshit recovery, which is about halfway back. Sell it. That bullshit recovery or the pullback is the bulge. All right? The initial reaction of the downward swings ends on March 4th at around 159. A point at which the market was previously supported on February 14th. Here we have a reversal situation which existed on January 23rd. The sharp acceleration of the down movement on March 2nd, 3rd, 4th creates an oversold position. What's he saying? If we're going straight down, it's going to create an oversold position. All right? Oversold. Sharp acceleration down without a correction is oversold. That's what happens. So what do you expect? Some type of pullback. At the same time that the average touches the former support level. What is the support level? It's right here. Right there. Right there is the support level, and it goes to support levels. So what happens? People buy. Why do they buy? They like to buy support. A condition that usually is conducive at least to an attempt at a rally due to the buying of traders who may believe the stock is again cheap because it's support at support. Our expectations of hesitation and a possible rally from this point are fulfilled as demand from the above sources brings a fairly rigorous run-up on comparatively light volume on the 5th. All right, so on the 5th, the 5th is here. A further rally to a higher top and a higher bottom the next day confirms our anticipation of a possible turning point for more recovery. All he's saying is you got this bar right here and there's a climactic bang down and it sets up the rally. That's all. Sudden increase in volume on the 6th. So what he's referring to is this. All right, that sudden abrupt volume may indicate climaxes of the rebound. So we wait for clearer indications. Why? The climax is going to lead to a potential rally. So we want to wait for that. Another higher low and a close near the high of the 7th says the volume of the previous session was climactic on the down. So what is telling you that it's a climax? Why? Because it has no follow through. It goes down, then it goes up. Red bar, down, green bar, up. Green bar after red bar tells you that the move down was a climax. That's not my, it's right here. That the close near the high on the 7th says the volume of the previous session, which was the 6th, was climactic on the down bar rather than the upside. This demonstrates a change from technical weakness to technical strength, brings in sufficient new demand to start a part-way recovery we have been waiting for. Why have we been waiting for? We're supposed to short the bounce. So all it's doing is, this is very interesting. Why? Because this is a move down, right? This thing is going down. Typically, it's on this bar that you're going to have a climax. See this bar? Because it's the lowest. So you figure they're going to buy support or something. So that's where it's, expect the climax. But this time the climax came on the test on this bar. And it was confirmed to be climactic on the downside by this bar, which was a green bar up, which indicated lack of follow through on the 6th. Instead, it told you that technical weakness became technical strength and is ready to rally. And tell me, can you see any of this without volume? The technical weakness, strength? No, it's not possible. That's why volume is critical. This demonstrates a change of technical weakness to technical strength, like I explained, brings in sufficient new demand to create that partway back rally, which is really the pullback, because it's a pullback from the rally down. So it's going to rally up, but that rally up is the pullback or the retracement or the halfway back or the 50% Fibonacci or whatever you want to call it. However, we do not expect this recovery to carry much above 165 because large interest would not be willing to help the market to go to a new high or get the other guys out even. Stating another way, big fellows would be anxious to run the market up to they would only go higher if there's more money to be made higher. All right. Meanwhile, we observed that the average from the 24th to the March 4th recorded a total decline of 14 points from the high of 173. A normal recovery of less than half would be 7 points. All right. Why? Because 173 minus 14 is about 160, so 159, so add 7 and you get around 165 or 166. Anyway, on March 10th, the average actually recovers 7 points right there, which is just halfway. This is the concept of a halfway back move. This is where it comes from, all right, from this study. Volume on this rally is not measuring up to the standard of the February rise behavior, which marks the rebound as purely technical. What's he saying? The February rise, this is the February rise. That's a lot of volume. All right, from this low to here is a lot of volume. Then it goes down. Then it goes back up. When it goes back up, you look at the volume, and that volume on that wave up compared to the prior wave up here is much less. What does that mean? It means it is purely a technical rebound. Volume on this rally is not measuring up to the prior rally, which marks this rally as a purely technical rebound and indicates the exhaustion of buying power as a result of filling up all the buyers on the previous distributive movement. What is the previous distributive movement? It is distribution. Where is that distribution? On the prior rally up here. What happens after this? The next rally here, or the pullback from the down move, is a technical rebound. That technical rebound, since it has lower volume, is helping further clarify that the prior rally up was distributive. Got it? All right. So what does it do? Volume of this rally is not measuring up to the standard of February rise behavior, which marks the rebound as purely technical. Why? Because it's less volume. It's a low volume pullback, bearish low volume pullback, and indicates the exhaustion of buying power as a result of filling up all the buyers on the prior rally up, the distributive rally up, thus confirming the probable accuracy of our deductions, all those deductions that had to do with distribution. Around the top of this rally, therefore, we take our additional short position. There you go. Additional short position, selling on the pullback. Right there. So what aids you in selling this pullback? That's the question. When would you sell a bear pullback? Well, what are the indications here? Obviously, he sees distribution. Obviously, he sees the move down. And obviously, he sees the pullback. And that pullback is a technical rebound. That technical rebound is halfway back, and it has much less volume. That because that volume is so much less, it's a technical rebound and indicative that the buyers got filled up on the prior rally. Okay? So let me just point that out. Here, they got filled. All the buyers got filled. Then it broke. Then it rallied halfway back. He established a short position here. Why? Because of low volume. What did that low volume say? It said that the prior move up here was distribution and the buyers are done. Confirming the probability. Around the top of this rally, therefore, we take our additional short position. I don't want to get into where the first position is, but obviously you know it's after the climax, right? Because this guy loves shorting the climaxes and buying the climaxes. Around the top of this rally, therefore, we take additional short position, selling at prices as close as we can to the danger points on the individual stock charts so that our risk is low. Further symptom of progressive market weakening of the market's position appears in the dip to March 13. The volume again remains comparatively high instead of shrinking as it did during the corrective reaction of December. January and the part of February, and on the 13th, we find the averages down to 158, which is a low point, lower than the previous supporting point. All he's saying is this makes a lower low. That's it. That's it. He's making a lower low, and the volume again is comparatively high with a star. In judging volume behavior, allowance must be made for the fact that declining markets normally are accompanied by lower volume than advancing markets, except perhaps at times when active liquidation is taking place. The reason for this is that bull moves must attract a much larger public following than bear moves. So this is something we don't really do that much, but he's letting you know that you're supposed to do it. And what does it mean? It means that the volume on the downside is typically less than the volume on the upside. Why? Because the public is taught to go long, not short, so they're not participating on the way down. All right, so you have to be able to detect that. The second thing is, he says around the top of the, we take our additional short position here. What else does he say? Further symptom of progressive weakening of the market appears in the dip to the March 13th. So March 13th is right here. You see this? It's a lower low. All right. The volume again remains high instead of shrinking as it did before. So he's saying that the volume is high on this down move here. Comparatively high instead of shrinking appreciably as it did during corrective reactions of December. So he's just comparing this pullback to prior volume pullbacks. Which pullbacks? In December. Here, January and February. So he's taking a look at this move down. And he's taking a look at this move down and say, oh, this is This move down now is more than this move down here, which is around 2 million and less. Here you have more, almost 3 million, right? 3 million, around 3 million. Here you have in the twos, not even 2, less than 2. Some bar have a little bit more, but these have less. Here again, under 2 million. Here again, this is a little bit different, but under 2 million, except like this one bar. Here again, you have 1, 2, these 2 bars, this is 3, this is like 1. So this block of volume is 2 and up to 3. So this volume down, right, this volume here on this move down is bigger than the pullbacks here, 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 and here. That's what he's saying. Is that bullish? No, it's bearish. Why? Moving down on greater volume means selling, meaning bearish. This substantiates the correctness of our general bearish position. All right, so what 2 things did he look at? He's looking at lower low with more volume comparative to prior pullbacks. He's taking this wave, comparing it to prior waves and saying, oh, there's more volume. And B, it made a lower low. In the following several sessions, there is irregular recovery to 166 with no material or consistent expansion of volume, except for the sudden increase on the 19. Now, I've beaten this thing to death. What does that sudden increase in volume mean? Again and again and again, he's mentioning what? Climaxing indication. This is why people don't understand that climax is not just ending and beginning a trend where this stupid idea comes where you go climax, secondary test, sinus strength, higher sinus strength, and blah, blah, blah. This itself is a pattern that's drilled into people's minds. Markets do not, they don't work like, I mean, there's more than one place where there's a climax. That's what I'm trying to say. And the second thing is, these types of sayings are like shortcuts where they're taking a 500-page course and trying to sum it up into a phrase, and that's not possible. But this has the earmarks of a climaxic indication confirmed by hesitation. So 2 things we want to take a look at, the first being climactic indication, and how is it confirmed by hesitation. Here you get the climax on the pullback, meaning the pullback from the move down. The lower low followed by the pullback, which makes a lower high, which has abrupt climactic volume right there on that bar, is indication that this move is done. It also is an indication that supply has entered and distribution, I guess you could call it minor distribution or whatever you want to call it, is coming in. Selling is coming in. All right. Now, confirmed by hesitation. What this word you see again and again in his course. Hesitation, hesitation, hesitation. What does hesitation mean? Lack of further upside progress is hesitation. So you got a climax and you have hesitation, meaning inability to continue, as indicated by ding and ding, meaning a lack of upside progress. How is he measuring upside progress? Most of the time, his references to progress are based on the closes. What do you see here? Close to close, they're clustered, meaning lack of net progress. And the second bar wipes out the prior 2 days closes. So that is hesitation. hesitation based on the inability of closes to make gains. So you have a climax. It is confirmed by the closes on the next 2 bars. This is another important point because a lot of times folks that are looking for climax, they just look at 1 bar after. In this example, he takes a look at 2 bars and says that based on these 2 bars, you see a reversal. You see no further upside progress on the next 2 days. We now also know that the average is faltering about a point below the top of the rally of the 10th. Basically, he's saying it makes a lower high at a level where our previous deductions led us to anticipate such a probability. We carefully watched for further developments, realizing that the average has reached a critical position. It made a lower low, it made a lower high, it climaxed, and now it's in deep shit. Why? Because you know that lower low and lower high, what that means, right? Trend and all of that. So, should new demand fail to come in now, we may anticipate a decline in proportion with the extent of the primary distribution of February. Where is February distribution? It's all the way back here. It's here. This is the initial distribution. It's not up here. That is distribution, but initially the distribution took place on the left shoulder. To better explain it using a pattern, the left shoulder had initial distribution. You had the hypodermic maneuver up here with a change of behavior, but that's not where distribution started. That's the highest point of distribution. You had distribution here, you had all that other stuff there, and right here you have a lower low and a lower high with a minor climax. If demand fails to come in here, then take the whole zone and get ready to project down. That's what he's saying. We now note also that the average is faltering about a point below the top of the rally of the 10th, a level where our previous deductions led us to anticipate such a probability. We watch carefully for the developments, realizing that the average has reached a critical position. Should new demand fail to come in here, we may anticipate a decline in proportion with the extent of the primary distribution of February, to which there has now been added secondary distribution on this March rally. What's he saying? Secondary distribution. What is primary distribution? Primary distribution is the left shoulder. The secondary distribution is the right shoulder. From the left to the right. Primary to secondary. Got it? This is more lateral movement over the next 3 sessions, featured by a weak rally on the 24th and 25th, making a total of 6 sessions during which the average has hesitated. All he's saying is you got 1, 2, 3, 4, 5, 6 hesitation. What hesitation? No upside progress. Ding, 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 ding. Hanging around. The market's inability to overcome the high of March 10th. Why? Because there's no progress. They're just hanging around. And its failure to even equal that level is clearly defined, affording final confirmation of the comparative safety of our short position. Likewise, a clear warning of the advisability of liquidation by investors who may not have sold up to now, since we now have all the elements to corroborate the prospect of a substantial decline. On March 26th, the average starts down, plunging towards lower support line. All right. On steadily expanding volume, you're going to notice these 2 bars. Expansion. It's going down here and here on expanding volume. Why is this important? When it starts to go down on a steadily expanding volume, meaning not abrupt volume, steadily expanding volume over the next 2 sessions, it tells us in advance that these former lows will not hold. What does that mean? It means the support is not going to hold. So you can determine that when that market is breaking, it's about to go to that support level. What makes you think it's going to break that support level? What makes you think that it's going to break that support level is when that down move starts, if it has heavy volume or steadily expanding volume, as that move starts down, chances are that the former support level will not hold. Why? Because the volume is expanding, not contracting, not tapering off. It means that there's active liquidation on the way down. And you can see that here where he says, this tells us in advance that these former lows will not hold. See? So I'm on 7M page 15, finishing it off here and going to 7M page 16. And that's enough for today. Take care. Bye.